Investing in stocks is more straightforward than most people believe. All you need is an online brokerage account to get started. This is the Wealthy Moguls channel, where we talk about all things finance and the growing economic markets. So make sure to subscribe to keep up with the latest trends. Investing in stocks has become more accessible as fintech has simplified the process by allowing newcomers to register an account through a website or mobile app. As a common shareholder, owning stock indicates your investment in a corporation. Shareholders of common stocks can vote on corporate issues, with most companies allowing one vote per share. Some businesses also pay dividends to stockholders. These payments are usually adjusted dependent on the company's profitability. Equity exposure in an investor's portfolio allows for the possibility of asset appreciation. When the value of your equities rises, you profit from market gains. Beginners should be aware that there are two methods to earn from stock investing: dividend payments and selling shares when the market value rises. Here's what else you should know about stock investment. Where should you begin investing in stocks? The first thing you should do is open a brokerage account. This account is required to make stock market investments. The following step is to fund your brokerage account by transferring funds from your bank account to fill trades for equities you want to acquire. The amount of money you choose to invest is determined by your risk tolerance, ambitions, and how much money you are willing to lose. Remember that while the stock market generally improves in value over time, there can be short-term market volatility which can put your money in danger. How much money should you invest in the stock market with? Several online brokers, including Betterment, do not charge fees for zero account balances and do not demand a minimum deposit to create a trading account. As a result, you can get started with as little as $100. Discount brokers are a godsend for newcomers with little funds who want to gain stock market exposure with smaller holdings. A bargain broker, on the other hand, does not often offer advice or analysis. In addition, many brokers do not demand a minimum deposit to open an account, while others have a modest starting point of $1,000. How to select stock investments? The answer to what you should invest in boils down to two factors: the time horizon for your goals and the amount of risk you're ready to take. Let's start with the time horizon. If you're saving for a long-term goal, such as retirement, you should invest primarily in stocks. Investing in stocks allows you to grow your money and outperform inflation over time. As you move closer to your objective, you can gradually reduce your stock allocation and increase your bond allocation, generally safer investments. If you're investing for short-term goals, say less than 5 years, you probably don't want to be involved in equities at all. Instead, consider these short-term investments. Finally, there is risk tolerance to consider. If you're prone to worrying when the stock market falls, you're better off investing slightly more conservatively with a lower allocation to equities. Are you unsure? In our post about what to invest in, we offer a risk tolerance quiz and other information about making this decision. Risks and benefits of stock investing. Individual investors can acquire stakes in some of the world's top firms through the stock market, which can be highly profitable. Stocks in general are an excellent long-term investment if purchased at a reasonable price. For example, the S&P 500 has averaged around a 10% yearly return throughout the years, with a hefty cash dividend thrown in for good measure. Long-term investors might also benefit from a tax break by investing in equities. You will not be taxed on the gains as long as you do not sell your shares. The only money you receive, such as dividends, is taxable. As a result, you can own your stock indefinitely and never pay taxes on your gains. However, if you profit by selling the stock, you'll have to pay capital gains taxes on it. The length of time you hold the stock determines how it is taxed. If you buy and sell the item within a year, the gains are considered short-term capital gains and are taxed at your regular income tax rate. If you sell after a year, you'll have to pay the long-term capital gains rate, which is usually lower. If you record an investment loss, you can deduct it from your taxes or apply it to your gains. While the market has fared well, many individual stocks have underperformed and may go bankrupt. As a result, these stocks will eventually be worth nothing and will be a total loss. Some stocks, on the other hand, such as Amazon and Apple, have continued to skyrocket for years, paying investors hundreds of times their initial investment. How to invest in the stock market. 5 beginner tips. 1. Purchase the appropriate investment. Choosing the correct stock is far easier said than done. Anyone can recognize a stock that has performed well in the past, but forecasting a stock's success in the future is far more challenging. If you want to be successful in investing in individual stocks, you must be willing to put in a lot of effort to evaluate a firm and manage the investment. When you start looking at statistics, keep in mind that the professionals are looking at every one of those companies with much more rigor than you probably can as an individual, so it's a tough game for the individual to win over. says Dan Katie, CFP Chief Financial Planning Strategist at TIAA. 2. If you're a beginner, stay away from specific stocks. Everyone has heard about a significant stock victory or a terrific stock pick. What they forget is that they are often not talking about those specific investments that they also hold that have done very, very poorly over time, Katie says. As a result, people sometimes have unreasonable expectations about the kinds of returns they can achieve in the stock market. They frequently mix luck and skill. It's possible to strike gold with a single stock now and again. It's challenging to be lucky over time while still avoiding major downturns. Remember that to make money in particular stocks regularly, you first need to know something that the forward-looking market hasn't already priced into the stock market. Second, keep in mind that a buyer is equally confident that they will profit for every seller in the market. 3. Build a diverse portfolio. One of the primary benefits of an index fund is that it immediately has a diverse variety of stocks. For example, if you invest in a broadly diversified fund based on the S&P 500, you will own stock in hundreds of companies from various industries. However, you might instead invest in a narrowly diversified fund and focus on one or two industries. Diversification is vital since it decreases the chance of any single stock in the portfolio negatively impacting overall performance, boosting your overall returns. In comparison, if you only buy one stock, you put all of your eggs in one basket. Purchasing an ETF or a mutual fund is the simplest approach to building a diverse portfolio. The products are already diversified, and you don't need to research the companies in the index fund. It's not the most thrilling thing in the world, but it's a terrific place to start, Katie adds. And again, it takes you out of the mindset that you're going to be so brilliant that you'll be able to choose the stocks that go up, won't go down, and know when to go in and out of them. Diversification does not simply imply holding a variety of stocks. It refers to investments distributed over several asset classes because stocks in related industries may move in the same direction for the same reason. 4. Be ready for a slump. Most investors find it difficult to accept a loss in their assets. And because the stock market fluctuates, you will experience losses from time to time. You'll need to toughen up to deal with these losses, or you'll be tempted to purchase high and sell low in a panic. As long as you diversify your portfolio, any single stock should not significantly impact your entire performance. However, if it does, purchasing individual stocks may not be the best option for you. Even index funds will vary, so no matter how hard you try, you will not be able to eliminate all risks. 5. Maintain your commitment to your long-term portfolio. According to Katie, investing should be a long-term endeavor. He also advises you to disconnect from the daily news cycle. By avoiding daily financial news, you will learn patience, which will be necessary if you want to stay in the investment game for the long run. It's also a good idea to revisit your portfolio regularly so that you don't become overly concerned or overly excited. These are excellent pointers for new investors who have yet to learn how to manage their emotions when investing. Some of the news cycles become very negative at times. It may become overwhelming for folks, Katie says. One method for novices is to create a calendar and schedule when you will evaluate your portfolio. According to Katie, following this rule will keep you from selling out of a stock during a period of volatility, or from reaping the full benefits of a well-performing investment. Investing in the stock market may be quite profitable, especially if you avoid some of the mistakes that most new investors encounter when they first get started. Beginners should develop an investment strategy that works well for them and stick to it through good times and bad. That's all for this video today, folks. Make sure to check out our other videos and click that big red subscribe button. See you again.